You're now listening to the Supply Chain Secrets Podcast, the ultimate insider's guide for all things ocean shipping. Brought to you by Kaishex, helping you deliver through volatility.
Hi, everyone. You're listening to the Supply Chain Secrets Podcast. I'm your co-host, Caroline Weaver, and with me is Lars Jensen. Lars, how's it going?
All great here. Still dialing in from my home office now, exactly 1 month away from my Synchro Sally voyage, journeying through Africa for 18 months.
The final countdown. Are you excited? Are you nervous? How are you feeling about it?
Excited, yes. Nervous, not really. I'm more in a state of mind saying, well, I'll probably get most of the stuff done. You're never going to be completely prepared anyhow, and things are going to change along the way anyway. So take it as it comes.
Yeah, a trip of that scale, you've got to be a little flexible with how things go.
Oh, yes.
But we're super excited to hear what you learned and share everything that you see. So yeah, it'll be really interesting for our listeners too. All right, let me pull up on the screen here and we can start off talking about Asia to US West Coast.
What we're looking at this time around is we're looking at the rate development both for 20 footers and for 40 footers for a change. Usually we only talk about 40 footers. The obvious thing to note here is the upwards momentum is simply continuing. We've been on an upwards momentum for a couple of months now. And the interesting thing is we have seen the gap between 40 foot and 20 foot expand a little. There was a while where 20 footers were actually closer to 90% of the 40 foot rate. Now we're falling back to the 80% level, which is historically more in line with where we typically see the split between 20s and 40s. Overall, this sustained continuous upwards momentum has a lot less to do with the Hormuz crisis and a lot more to do with an overall strong supply-demand situation. At least some of the shippers I'm talking to are also basically saying they are having challenges in some cases finding space. So the supply-demand situation is definitely what's driving the overall Pacific rates up. We're not showing the US East Coast rates here because that would basically be redundant because the momentum and the movement is in essence more or less a carbon copy of what we see to US West Coast, of course a little bit offset in the dollar amount. What I would then like to do, we've been talking the last few weeks about how the Northeast Asia rates seem to be the odd one out on the Pacific in terms of rates following more or less a wavy sine curve around the other Pacific rates. That's actually the case this time as well. So I would rather here today also focus in on these are both the 20 and 40 foot rates. And just like Northeast Asia is the odd one out when it comes to showing this wavy movement around the other ones, they're also the odd one out when it comes to the difference between 20 and 40 foot rates. This is a trade where within the year we've had multiple cases where we have seen in some weeks 20 foot rates effectively pay more than 40 foot rates. So the rate formation when it comes specifically to Northeast Asia, to US West Coast, really is subject to some local fluctuations above and beyond the Pacific. It does follow the Pacific pattern, absolutely. But on the week-on-week basis, there's a lot more volatility going on here than if you're moving cargo from not just China, Taiwan, but also from all the other locations further down in Southeast Asia. So South Korean and Japanese exporters, they're simply faced with more intra-week variability than the other Pacific trades.
Yeah, interesting. Maybe let's talk a little bit about where the futures are at, starting with the Asia to US West Coast.
Sure. Here we're looking at the Asia-US West Coast. We could have chosen to show the US East Coast. Again, the pattern would be the same, albeit offset with a dollar amount. What I find interesting here and what I expect to see happen is we are likely going to see these futures curve change in the short term because we now have spot rates exceed what the first coming future rates are. They're actually now even exceeding the futures indication for the apex of the market in July. And given the continuous upwards momentum and strength we're seeing in that market, it at least appears the most likely right now that momentum will carry on. So the futures rates we are seeing right now for June and July are likely to move upwards within the next week or so as well. It's not going to stay this way. And that, of course, also means let's have a look at the other main trade, the Asia-North Europe trade, because Asia-North Europe is also subject to significant continued spot rate increases, again driven by a strong market. This is mainly supply and demand at work. And what we have seen here are actually significant changes in the forward expectations reflected in the futures curve. If we look at the upcoming peak season, the futures rates have now been increased a few $100 just compared to last week, with the apex year still being in July, but basically all of June, July, August being the peak we're heading into. This matches what we're roughly seeing in the market, where peak season is clearly coming underway early, and that's what we are heading up into. The curious part is when you're then looking beyond it, the expectations of the market participants in the futures market is, however, that this peak we are running into is then going to run into a sharp and abrupt end already in September, because the September futures rates have been adjusted downwards compared to last week. So the market participants right now expect a strong peak on Asia, North Europe, an early peak, but they also expect it to end relatively early, so not on first week of October as usual when we see Chinese Golden Week, but basically already from September. This has been adjusted downwards. And also what I find interesting is if we look way out into the future to peak season 2027, it's not that there's a lot of variability in the futures rates just yet, but this one has actually been adjusted slightly downwards as well. So there's more bearish expectations coming in for peak season 2027 already. So let's see how this unfolds, but I'm not surprised we're seeing this upwards revision of the futures rates for peak, and as mentioned before, I would expect to see a similar upwards momentum potentially come on the Pacific rates as well. Now, we can only compare to last week. We have now seen 3 separate adjustments upwards of the peak rates, which again, if we are the Monday morning quarterback, everybody always loves a Monday morning quarterback. Then, of course, we could say that if anybody actually managed to then secure and wanted to secure a hedging contract on their prices, and they did so a month and a half ago, they would be set pretty well for the peak season that we're getting into. Of course, that's Monday morning quarterbacking. We can't use that for anything now, but just to point out what some of the opportunities are with these tools.
Yeah, that's a good call out. Hindsight is definitely 2020, but
yes,
yeah, it'll definitely be interesting to see how the Asia to US West Coast trade adjusts, if it does, over the next week. We'll definitely report on that. But cool, good stuff here. I'm curious, as we've been talking about the rate, have you seen any major announcements from carriers in terms of peak season surcharges, GRIs, things of that nature?
Yeah, over the last week since we last spoke, there's been a flurry of announcements for basically all the major carriers. In essence, they're all coming with various types of freight rate increases, FAKs, GRIs, whatever have you. So they're increasing overall rates, especially on the Asia-Europe trades. Some cases also Asia-South America and Asia-Africa trades. And on top of that, we're seeing carriers come not just with FAK rate announcements, they are also putting additional large peak season surcharges on top. So again, this is clearly down the usual playbook of the carriers. The market is indeed strong, which means that when the market is strong and there is, I wouldn't say scarcity of space, but at least pressure on getting the space, then the carriers will, of course, also try all the tools they have in the toolbox to increase rates to reflect that situation while they have the opportunity. That's exactly what we're seeing.
Interesting. So it's not necessarily part of the Strait of Hormuz. This is really just par for the course in terms of approaching peak season now.
It is, and you can say it's not Strait of Hormuz, yet to some degree indirectly it is, because this is the Red Sea crisis still in full effect. And as we've spoken about a lot over the last year, the Red Sea crisis, of course, means everybody goes around Africa. That soaks up a lot of capacity. That is why we have an issue with capacity. As long as the Hormuz crisis goes on, the Red Sea crisis will go on, and this doesn't really get resolved. The last couple of years, I've been having this global model, trying at least on an annual average to look at what's the global supply and demand balance. And the moment it became clear that the Red Sea was not going to open as everybody thought 3 months ago, that basically means the global supply and demand balance is the same as it was in peak season last year. So we shouldn't expect the markets to be any weaker than what we saw in peak season last year.
So even the effect of the tariffs and all of the new vessels that have been built, really the balance is about the same?
It is about the same because 2026 doesn't actually see a massive injection of new vessels. Of course, there is some injection of new vessels, but it's not all that much. This massive order book we're talking about, that really only starts from 2027 in terms of delivery. And on the demand side, yeah, there's definitely been a negative impact from the trade war on US volumes, but the global average is doing just fine. I mean, most other trades are still booming.
Yeah, that's true. We did talk about that with the demand coming from other countries and trades really propping up the global demand levels.
Yes.
Well, let's actually circle back to something we started talking about last week. So looking at the consumer sentiment versus container volume, I had asked you, is there a correlation between it? Do you tend to see them both rise together? And you said you had to look into it. So did you have time to look into it? Could we talk more about that?
Yes, absolutely. Because it's one of those where it's a good question, and it always irks me if I don't have the answer to a good question or haven't looked into it. And you can say, in terms of numbers, consumer sentiment, this is the University of Michigan. They measured it since the 1950s. And the latest measurement for, what was it, April, came out the lowest they had ever measured. And if we just sit back and think a little bit about it, a knee-jerk reaction would be, okay, if consumer sentiment is that bad, then presumably negative consumer sentiment leads to a reduction in consumer spending, which should lead to a reduction in containerized demand. Now, markets have changed dramatically since the 1950s. So what I chose to do since we spoke last is I set a little baseline 2018, 2019 before the pandemic, and then we follow through all of the disruptions we've had, pandemic, Ever Given, stuck in Suez, trade war, Hormuz, everything, and looked for how much of a correlation is there between the consumer sentiment and measured on two things. Is there a correlation to the actual volumes being shipped in containers into the US, or is there a correlation to the growth rate in the volumes being sent in? And the answer basically is no, there isn't. Whilst logically it would seem there should at least be some reasonable degree of correlation. If we're trying to correlate the consumer sentiment to the growth in container volumes, the best we get is a correlation coefficient of about 30%, which in statistical terms means, there's not really anything to come after there. If we look at the correlation and do it straight over to the absolute volumes measured in TEU, again, it's about 0.3, but it's a negative 0.3, which means the numbers are telling us if consumer sentiment goes down, we're importing more volume, which is completely counterintuitive and basically just supports the underlying interpretation. If we look straight at the numbers, we cannot, no matter how much it is, I wouldn't say desirable, but tempting. No matter how tempting it is to say, oh my God, consumer sentiment is going down, that will have an impact on container volumes. There's actually no statistical basis upon which to base that sentiment. There might be some indirect effects in between that could then potentially be modeled out, but a straight link between consumer sentiment and changes in container volumes doesn't actually exist.
That's fascinating. Yeah, I definitely would have assumed there would be some level of correlation. I guess there is, but it's not significant.
Yeah. I mean, exactly. You can always roll out, yes, there's 30%, but I mean, come on.
Yeah.
30% is not really much in correlation terms.
Yeah, and I guess it's something to keep in mind, like container volumes are driven by inventory cycles, sourcing decisions. Like there's more to it than just how does the average person feel about the economy. So
yes.
And then the timing is different. They're operating maybe on two different clocks that move at different speeds. So yeah, it makes sense that it doesn't necessarily show.
Yeah, and then there are multiple other effects that are hard to monitor. Let's say you suddenly feel the pinch. So you're sitting there and say, oh my God, I need a couple of new dresses, for example. You might still go out and buy the dresses, but you might buy them cheaper than you otherwise would have.
Yeah.
But from a container perspective, it takes up exactly the same physical volume. So whilst in monetary terms, we might see a reduction in consumer spending, that might not translate to the same reduction over on the container side.
Yeah, that's a very valid point. It's something that people might not think about. But yeah, the physical space is still the same.
Yes.
Awesome. All right. Well, thanks for following up on that. Let's talk a little bit about the Strait of Hormuz. What updates have we seen over the last week?
I was about to say the best we can say is that there's no improvement, but that's not even true. There seems to be a slight deterioration. Despite all the fanfare over the last week that now there was an imminent deal, well, it kind of feels like Groundhog Day. We heard that quite a few times before, and lo and behold, no, there was no imminent deal. There is no change in the situation. When I say, if anything, the situation has turned slightly worse. We have had a couple of bombing strikes from the US on facilities in Iran. Then we have seen Iran first do a few drone strikes against Kuwait a couple of days ago. And I was actually seeing just a couple of hours before we started taping the podcast here, there were more drone strikes from Iran on Kuwait. And in case our listeners are wondering, why would they bomb Kuwait? Well, because there's a large US military base in Kuwait. That's the one they're actually targeting. So there is absolutely no change. And is there any hope of an imminent deal? We had the Iranian foreign minister, again, within the last, I think, hour and a half, was out saying that Iran's position is also that a ceasefire and a deal between Iran and US is contingent upon a ceasefire and a peace agreement that Israel pulls out of Lebanon, which just upped the ante quite a lot and makes it even more difficult to see how we could see a resolution on this in the short term. Another worrying element, remember a week ago we had basically breaking news because a ship had suffered an explosion in the Gulf of Oman. Ever since then, there's been no news that this was hit by neither a missile or a drone, which seems to suggest they might have run into a mine. And interestingly, UKMTO, the authorities that are reporting from incidents down there, are quoting the Omani maritime authorities that a couple of days they found another suspected item floating in Omani territorial waters that they suspect is a mine, which just makes this whole situation even more troublesome. And again, circling back and say, there is no improvement in the situation, and from the looks of it right now, it could be quite a while before this gets resolved, especially now with Iran demanding a solution to the Israel-Lebanon problem as well.
Yeah, that definitely adds a layer of complexity. I was curious to ask you, is there a way to estimate the number of vessels that are either stuck there or just can't go into the area? Maybe a follow-on to that is how many TEU are impacted directly by this?
Not easily. There are a couple of issues. On one hand, it's not all vessels that have their AIS on, which means that makes it somewhat dodgy. You can count the vessels that do have them on, but that would not necessarily capture all of the ships. But we should also keep in mind that quite a few of the vessels that are inside the Persian Gulf are not trapped there. They're moving cargo in there. They'll have feeder vessels, though. You also had that before the crisis. But let's make a very practical example. I mean, all the carriers have practical examples. The latest one I saw was Musk a couple of days ago, announced that they are now shifting how they direct some of the cargo into the Persian Gulf states. So this will be if you want to go into, say, Qatar, to Iraq, to Bahrain, some of these countries that are only facing the Persian Gulf. The cargo will now be discharged in Khor Fakkan. It will then be run by truck over to the Persian Gulf site. And then they will be reloaded onto feeder vessels there. And then they'll be sailed up to the Gulf countries. I mean, these vessels are not trapped. You can count them as vessels inside the Persian Gulf, but I think it would be a complete misnomer to call them trapped because they're operating perfectly fine in there.
Interesting. So I guess it's maybe a word to the wise that if you do see numbers, they likely are not, because it's just hard to estimate.
Headlines tend to focus on the largest possible number they can get somewhere in order to make it sound cool.
Yeah. Yes, very good point. So are there any updates in terms of carriers moving vessels through the Suez? I know we spoke about one with CMA. Has that changed at all?
Yeah, there was one. I actually noticed that's also just about a week ago. I noticed one of the MSC ships, an 18,000 TEU ship, turned off its AIS after having been sitting at anchor. And then it was simply just off AIS for 5 days, only to then reappear on the other side of Africa. So you can say, turning off AIS, MSC has actually managed to exit an almost 8,000 TEU ship. Good for MSC, that vessel can now be used somewhere else. I don't know, and I have been able to find out under which conditions it was moved out. Was it just turning off the AIS and hoping for the best? Was it some sort of military protection, or was it in agreement with the Iranians? I simply don't know. I can just factually see it was in the Persian Gulf, and almost a week later, it was no longer in there. It was off the West African coast.
Anything else you want to add there? Should we move on?
Yeah, I think maybe the last one to add, now that we did talk about the importance of the Red Sea, CMA CGM continues to be the odd one out. They continue to slowly increase the amount of vessels that actually go through the Suez and use the Suez routing. The latest, that was several weeks ago, they had one vessel on the head haul that goes from Asia to North Europe, and that's on its way now. And here over the last week, they also changed their schedule, so now one of the vessels on the backhaul on the FAL3 service is also taking the Suez routing. So whilst everybody else still goes around Africa, CMA CGM continues the modus operandi they basically had for a year and a half. And Not with everything, but for some of their services actually go through.
Yeah. It seems like that would also be a bit of a competitive advantage at this point, since all the other carriers are not going that routing. You have a faster transit time.
You're definitely at the faster transit time. Whether it is commercially more competitive is maybe more of an open question, because they are likely paying much more in terms of war risk insurance. Plus, of course, they're paying the Suez Canal toll, which the other carriers are not.
Yeah, valid point. All right, well, let's switch gears a little bit and talk about the China PMI. First, can you explain what that is and tell us why it's important?
Yeah. The PMI, also known as the Purchasing Managers Index, many different countries have it. I think actually in the US was the first ones to come up with that measurement. What in essence it is, it's a survey of a lot of manufacturers that's done monthly to gauge a number of business conditions. So how is it going with your sales? What do you expect for new orders? What's happening with your prices of raw materials? What's happening with your employment? And it's a diffusion index, which means it's between 0 and 100. And if it's 50, then things will be the same next month as they are now. If the index come up above 50, that means things are increasing. And if it's below 50, it means it's decreasing. The last couple of months, the Chinese manufacturers PMI has been above 50. It has now been reduced slightly in the new measurement down to exactly 50. It should be noted that over 2025, 11 out of the 12 months actually were slightly below 50, yet Chinese export trade growth still grew 6%. So even though this is slightly below 50, doesn't necessarily mean that Chinese exports are going negative, not even by a long shot. So to me, it still looks like the manufacturing sector seems to be doing quite okay. One of the interesting things when you look into the sub-indices, at least the one that had piqued my interest, is the sub-index where it comes to the prices of raw materials. Because that one has been hovering, I think, roughly between 51 and 55 for the past year, so slight upwards pressure on raw materials prices. After the Hormuz crisis, that has shot up to way above 60 in terms of measurements, which in these index measurements is actually quite high. So it's very clear that the Chinese manufacturers are now seeing and expecting a substantial inflationary pressure on the cost of the raw materials they use, which, and there's no other way about it, that will then subsequently in the coming many months slowly also make its way into the supply chain and eventually out to all the consumers around the world as well.
Yeah, so in theory, wouldn't that also increase the amount that importers that are exporting from China would have to pay on tariffs as well?
Ooh, that is a very good question. Offhand, I would tend to say yes, because then the goods become more expensive and there's a percentage on top of that. Seems to be the gift that keeps on giving here.
I would agree there. Cool stuff. Last thing that we wanted to talk about today were some imbalances with global trade. Can you talk about what you have found?
Yeah, I did a little analysis here over the weekend, and if you want the details, it's actually in the Sea Intelligence newsletter, but just the highlights of it. I mean, I became curious in terms of how much has trade imbalances really changed since before the pandemic, because whenever we talk on a monthly basis, it's always that some of these head-haul trades, so Asia to Europe or Asia to North America, Asia to South America, has always grown faster than the backhaul, which of course leaves more and more empty containers to be moved around. And the interesting thing is, if we look at imbalances, if we measure it just in containers, so in TEU, since before the pandemic and then up to first quarter this year, the number of full containers being shipped in the world is up by 17%. That's actually not a lot, because if we stop and think this one through, if full containers are up 17%, how much has the fleet grown? The fleet has grown 43%. And we started out earlier here today talking about how the ships were full and there were pressure. And before anybody says, well, hang on a second, if capacity is up 43%, demand is up 17%, how come the ships are full? And again, this is the Red Sea. Because if we measure demand not in TEU, but in TEU miles, which we really should, because that's the amount of work that needs to be done, then demand is actually up as much as 41%. So basically matching. So this is why the ships continue to be full. This is why the Red Sea crisis is so important. But then in terms of imbalances, if we are up by 41% in TEU miles, how much is we then up in empty containers? We have doubled. It's up 102%. So compared to 2019, we're now moving twice as many empty containers as we did back then, which is a pretty wild increase, to put it mildly.
Yeah.
And in these days where it's also important to talk about cost and cost increases, this is one of these hidden cost increases. Because these are empty containers. There is a cost associated with moving them. There is cost in the ports associated to loading and unloading them, getting them back to the depots where customers need them. That's an added cost of the carriers. And at the end of the day, this cost can go only one place. That is to the shippers of the full containers. So whoever ships full containers are in a situation where they are increasingly having to pay for more and more empty container repatriation, because global trade is just becoming more and more lopsided.
And so is that just coming through as a line item on invoices from carriers? Just the empty repositioning?
No, it isn't. Because again, here you get the problem. Let's say right now it's pretty extreme on Asia, North Europe. You got a 4-to-1 imbalance. So I'm shipping 4 containers to Europe and can only get cargo for 1 going back. So I'm left with 3 empty containers. Who do I send that invoice to? 3/4 to the 4 that are full, or how do I do that? So no, that doesn't come through as a surcharge or a line item. In some instances in the past, if it has been a very unique situation, you have seen some container positioning fees. But overall, for the major trades, this is part and parcel of the base rate you're paying.
It's a shame that you can't just like collapse the containers and then they take up way less space.
Well, it sounds sympathetic, but here's the issue. That would increase the cost. Because keep in mind, if I'm filling the ship, well, let's just say 20,000 containers going from Asia to Europe, then I will only have 5,000 full containers going back. So I've got 15,000 empty slots where all the empties can be. So it's not that we are lacking space for the empties. If they went in one direction, there's also space on the ship going in the other direction. If you collapse the containers, the only thing you accomplish is now you need to do more work on the containers. More work equals more money. The only place where collapsible containers actually have a viable business case is for relatively contained flows where there's a lot of inland movements involved as well. Then it suddenly makes sense. Because let's say I'm driving 4 containers from, let's just make up something, from Seattle way into Kansas. That's 4 trucks driving it in there and discharging it. Then the importer might have those containers down there for a week and getting them empty and whatever, and now they need to be driven back to Seattle. But if I can collapse them, now I only need 1 truck to drive it back. Then it makes sense.
Yeah, it's interesting. I guess the vessel is still the same size and still needs to go back regardless.
Yes.
So maybe we need
Yes.
collapsible vessels.
An accordion vessel.
Yeah, I like it. All right, Lars, anything else you want to add for today's episode?
No, I think we covered basically all of what has transpired since last week.
Yeah, good full episode. Thank you everyone for tuning in. If you haven't subscribed already, we are on Spotify, Apple Music, YouTube, you name it. And we'll be back next week for a new episode. Bye everyone.
Thanks for listening to the Supply Chain Secrets podcast, presented by NiceX. Be sure to subscribe on your favorite podcast app.